Okay, I believe we are live. I've got the indicator here that we're live. Welcome to another webinar. My name's Dusty. I am not Steve Harper. This is Dusty today with Veritas Capital Investment Group. We're a small boutique brokerage out here in Northern California. We do webinars with professionals in the industry. Our specialty is helping apartment owners trade in their apartments or rentals for low management assets like Starbucks and Taco Bell. My information will be at the end. If you're finding this online, it'll be should be at a link there as well. Today we're talking about cost segregation. We have Bill Mark with us today. He's the director of cost segregation for corporate tax incentives, and he's going to teach us a little bit about cost segregation today. Bill, welcome to the webinar.
Thank you, sir. I appreciate the opportunity to join you guys today and hopefully teach you a little bit about cost seg.
Yeah. Tell us a little bit about corporate tax incentives, the group there.
We're a specialty tax firm here based out of Northern California. We specialize in a couple of different incentives. Research and development is a big ticket for us. There's a WOTC incentive for work opportunity tax credit. And then we also specialize in cost segregation, which is what I oversee here with us. We have offices here in Northern California, Southern California. We have a big R&D office in Houston as well. We are nationwide. We'll go anywhere for any project.
So not just real estate, but I mean, you got businesses covered, large and small. Sounds like you got a lot of, if you own a business, they need to be speaking to you.
Correct. There's usually, it's free for any client to contact us and kind of talk to us and see if there's any kind of tax incentive that we can help them out with.
Great. Yeah. So if you're listening to this after the fact, Bill's information will be at the end as well, and as well as in any link. If you're finding this online, you should be able to see his information there as well too. So, cost segregation and fixed asset review. Why pay more taxes than you need to? Probably go to our next slide. Right there we go. So tell me about this.
Okay. Before I jump into the slide, I'd like to just talk a little bit about my background as well as the other major player on the director side of our team. I have a civil engineering degree from Clemson University. Go Tigers! I actually started out in the commercial construction general contracting world as a project manager and did that for about 10 years before transitioning to cost seg. And I've been doing cost segregation for a little over 6 years now. And so I bring the engineering and construction expertise to this team. And then my other partner, Philip, he comes from the other side. He has a master's in taxation, he's a licensed CPA. He's been doing cost seg for well over 20 years now. And he's developed his construction knowledge just through field experience over all these years. So those together, we have a good mix of the construction, engineering, and tax expertise that you need to put together a quality study.
Now, would they replace their CPA with you guys, or is that kind of something where you work with their CPA? How does that work?
They would not replace us. We assist their CPA in providing them with the cost seg study. We don't provide any CPA services.
Got it.
But we work hand in hand with them with pretty much every project.
Great. All right. So I don't know if you're going to go through this initially, but I figured, like the basics of cost segregation, this has to do with depreciation versus straight line depreciation, correct?
Correct. So on this slide, what I like to talk about is essentially the definition of cost seg and how it works. And I'll give a couple of examples of personal property. But Cost segregation is essentially a tax planning strategy that maximizes depreciation in order to generate cash flow for the client. We maximize depreciation by separating different construction components of a building and assigning those to shorter class lives. Those shorter class lives are what allow us to front load the depreciation. The client pays less in taxes in the early years of owning that property and therefore generating cash flow. That's essentially the number one goal of cost segregation. Essentially how that works is every building has a cost associated with it. Whether it's an old building, something newly constructed, something that was recently acquired, they all have a cost, a basis, if you will. And without cost segregation, as you mentioned, it would be depreciated on a straight line method over 39 years or 27 and a half if it's a residential rental property. What cost seg allows us to do is come in, perform a detailed engineering analysis of your building. And the goal is to separate the personal property from the real property. Personal property is going to be everything that we're going to put into a 5, 7, or 15-year shorter class life, while the rest of that pot of basis will remain in the 39-year or 27.5-year class life. And those 5, 7, and 15-year shorter lives, that's what creates that accelerated depreciation. The client generates the cash flow. Okay? So that's the high-level overview of the cost saving and the basics of how it works.
So just to recap, if you've got an apartment that's going to be on a 27 and a half year, essentially, if it were a straight line, you'd be writing off the improvements with the 27 and a half years. Commercial buildings are on a 39 schedule. And now what you can do, so take me through that. Can you break out the windows and put them on their own schedule? Or is it just like fridges and personal property?
So what our cost seg study will do is it will provide you with a tax basis for every component of the building and not just the personal property. So we are going to give you a value for the windows, for the roof, for the walls, the structure, etc. Every major component of a building will be broken out at the end of our cost seg study.
Right. And generally speaking, so the building itself, they say 39 years, for example, but most of the different components of that building are going to be on shorter schedules, the 7-year, the 5-year, the 15-year schedule. So that's why you can front load the write-off for these things closer in toward the first 15 years. Is that right?
That's almost right. I wouldn't say most of the components. There's a slide that we'll jump into a little later that kind of gives you the typical percentage of shorter life property that you could expect depending on the type of building. But to give a couple of examples of personal property, I like to give two. One's kind of pretty basic and easy to understand, and the other one kind of gives you detail of how it can get a little more complicated and require some engineering. But the first one, if you consider ceramic tile versus carpet flooring, ceramic tile, it's a very permanent in nature installation. It's grouted to the slab. It's not going to go anywhere very easily. It's going to be very difficult to remove. Also, you expect ceramic tile to last 20 years or more as long as it's properly maintained. That permanent in nature aspect of the ceramic tile makes it real property, 39-year or 27 and a half. Now compare that to carpet, on the other hand. You can remove and replace carpet many times over the lifetime of the building without any difficulty, without worrying about damaging the slab underneath. And then obviously, you don't expect carpet to last more than 5 to 10 years, depending on the foot traffic you have. So it's not very permanent in nature, and that's what makes it personal property, and it'll carry either a 5 or 7-year class life, depending on what type of building it's in. The second example involves lighting. If you walk into an office building and you look up in the ceiling, typically what you'll see is 2x4 light fixtures and a grid ceiling. In the cost seg world, we like to refer to those as general lighting. you have to have that lighting in that building in order for it to function. Okay, that makes it real property, 39-year property. On the other hand, in that same office building, you may have what we call decorative lighting. Maybe it's track lighting or some recessed cans that are highlighting some artwork on the wall. Again, we term that as decorative lighting. The building does not need that to function. So that makes it personal property 5 or 7 years. Now, not only are we going to take the cost of that light fixture and allocate it to personal property, we're also going to calculate the conduit and wire from that fixture all the way to the electrical panel. We are going to calculate what is the electrical load that particular light fixture takes, and we're going to assign a dollar value just to that electrical load. And all those components for that one fixture make up the personal property. So that gives you an idea of where some engineering comes into play with Cost Seg, and where you really need a qualified Cost Seg provider to do your study for you, so you can make sure you're capturing all the benefits that you can. There are CPAs that can pull out easy items, for a Cost Seg study, such as carpet, maybe some items out in the site improvements, such as paving or site lighting. Several CPAs will know that they can pull those items out and allocate them to a shorter class line. But getting down into the details and really maximizing the benefit requires a qualified Cost Seg professional.
Got it. Okay. All right. Well, I don't want to get ahead of ourselves. So do you think we should move on to the next slide? I don't know. Yeah, let's see here.
Okay. So I kind of touched on the primary goal of Cost Seg when I mentioned the definition of it, and that's to generate the cash flow. That's the number one reason why we get contacted by CPAs and clients to conduct a Cost Seg study for them, is because they're looking for that tax savings. Right? You oftentimes hear or see the term time value of money when it comes to Cost Seg studies, and that just means they would rather have significant tax savings up front versus spreading that tax savings out in small amounts over 39 years or 27 and a half. So that's where you'll see time value of money sometimes. But that secondary goal that clients don't often realize they get from a Cost Seg study is, and we touched on this a little bit before with your question, Dusty, but we're going to establish a tax basis for all components of the building. The roof, the windows, HVAC, etc. And why is that important? Well, let's say 5 to 10 years down the road, the client wants to renovate their building, and they replace all their windows. Well, now, if they had a Cost Seg study done, they're going to have a starting point to calculate the remaining depreciable basis of those windows, so they can write that off, and they don't have to continue to carry that value on their books. That's kind of a secondary advantage to having Cost Seg.
Okay. So I just want to recap, in case people watching this, they might be smaller investors or perhaps real estate agents. So just to recap, depreciation for a commercial building or a residential building means for commercial, you're writing off 1/39th over 39 years of the improvements every year, right? So over 39 years, you're writing off 1/39th of that. By using this strategy, you're essentially trying to front load as much as you can the value of those improvements in the first couple years, as much as you can, right? And so what he's saying here is you're breaking out the different components of that building, like the roof and the windows and the HVAC, and you're putting them on their own schedules that are usually, or hopefully, as much as possible, on a shorter term than the 39 years. And so what does that mean? If I replace all the windows, I claim the remaining value once I'm doing that. Is that correct?
The remaining depreciable basis, yes. So depending on how long you've had those windows in place, there's a certain amount of accumulated depreciation that you have to take into account. And then there's going to be the remaining depreciable basis left in terms of the value of those windows. And yes, that's what you'll get an immediate write-off of on your next tax return.
So do I create a new? So I replace the windows, right? So just for the sake of having numbers to it, the remaining value of the windows was 10,000. So I claim 10,000 on my next tax return. Yes.
And you capitalize the cost of the new windows.
Okay, and then does a new schedule get created for the new set of windows?
Most likely, it depends if that window replacement is part of a whole other big renovation, and you have another cost seg study done on that renovation. Then again, you'll have all those components broken out. Or if it's simply just a window replacement, it'll probably go on the depreciation schedule by the CPA as just improvements at 39 years. So it kind of depends on what's the magnitude of the total renovation. Just windows or just several things all in one.
How does that work for an acquisition? Say I know I've got an old roof on my multifamily I'm buying. I know I'm going to replace it in the next 2 years, just thinking in my head. Do I have to have a schedule when I'm doing the study? Is it going to say there's only 2 years of value left on that roof? Or
Well, that one gets a little tricky. So if you acquired a building and you have a cost seg study done on it, then yes, we'll be able to help you identify what is the remaining depreciable basis for that roof to write off if you replace it. However, I will say there was a change to tax laws in regards to Section 179 expensing, where roofs now qualify under Section 179. So if you replace the roof, you would most likely just expense the cost of that through Section 179, and not because you'll get more value that way versus trying to uh, write off the remaining basis of the existing roof, because that's going to be a much smaller amount.
I like it. We're getting real nerdy here. This is why we usually have Steve on, because he's not as nerdy as I am, but I like all the nerd stuff.
Okay.
Right. So timing.
Timing.
What does this have to do with?
Okay, we often get asked, okay, what's the right time to do a cost seg study? And honestly, the answer is any time. And what we're talking about here is in terms of the place and service date of the property. So in the before situation, obviously we're talking about in a new construction project. It hasn't been placed in service yet. And what I like to talk about here is it could be a big advantage to get a cost seg provider involved early in the construction process. You don't have to wait till the construction is done. And the reason being is we're going to be able to look at the drawings, the specifications, all the construction data, and generate a list of all the personal property items we think qualify for that job. And what we're going to do is we're going to hand that list over to the general contractor. I'm going to say, hey, Mr. GC, I need you to track the cost of all these items. And then when the project is done, he hands that list to us with real-time accurate cost data, which instantly increases the credibility of our cost seg study, right? Because we have real-time data from the contractor. It's just much easier to track throughout the job versus trying to go back to that same GC 6 months to a year down the road after he's moved on to 2 other jobs at this time. Trying to ask him, hey, Mr. GC, what was the cost of this fixture or this amount of concrete versus that amount? It's just much harder to get that information at that point versus allowing them to have the ability to track it throughout the project. It's much smoother process there.
Okay.
The current situation, that's usually when we get contacted the most, when somebody just acquires a building or just finishes the construction of the building. That's usually when we get contacted, which is fine. That there's still enough documentation and records at that point that we need to do the study. In the after category here, what we're talking about is properties that somebody has owned for a year or more, and maybe they've owned it for 5 to 10 years. And this is something that a lot of people don't realize with cost seg. It doesn't have to be a new property or a new acquisition. It could be something they've owned and had on the books for several years, and we can still do a cost seg study on it. thing that we're looking to do here is get that Section 481A adjustment, which is the catch-up depreciation that they've missed for all those years that they've owned the property and didn't have a cost seg study done. And the other important thing I would point out in this situation is you do need a Form 3115 filed with your tax return in order to take advantage of that 481A adjustment. That is an additional service that is required, and we can do that, or your CPA can do it. I will say 99% of the time when it comes to a cost seg study being involved, the CPA would just rather us do it. It's much easier for them.
Yeah.
Honestly, it's much easier for us. It does come at a little bit of a premium because it is an additional service.
Okay. So so if you own, I'm just thinking selfishly for our clients that own multifamily who aren't, looking to transition right now. If they currently own the building, they don't have to do this within a year or right when they acquire a building. They could have owned it for the last 10 years or 5 years.
Correct.
And still go back and create a kind of, you're saying a catch-up kind of survey, look back and see where it's at now?
Correct. I mean, obviously, they'll get the most benefit if they do it in the initial year that they own it.
Right.
But the point is, yes, you can still receive a significant benefit even if you've owned it for 10 years.
Does this work? Because our clients usually what they'll do is they tend to be in retirement age. They're selling their apartments. They're exchanging into a net lease property. If they own a building like the Taco Bell building, for example, and Taco Bell's the tenant, they still get to do cost segregation, or how does that work?
They do. Now, what will happen is they'll get a much smaller benefit because I guess it depends on really who provided the funding for the improvements on the inside of the building. So did the owner build that entire building and then Taco Bell came in and they're leasing it, or did Taco Bell build out that entire interior?
I would usually assume for our purposes that the owner developed it, built it, put Taco Bell in, and then sold it to our buyer, for example.
Okay. So in that situation, then the building owner owns all the improvements on the inside of that property. And yes, any restaurant property is a great candidate for cost seg because there's a large amount of personal property in every restaurant.
Great. Very cool. All right, so let's see. Next slide here. Okay.
What we're showing you here is basically we like to categorize our studies into these three different types. Any kind of new construction or renovation remodel, we just simply call that cost segregation. Anytime a client acquires an existing building, we refer to that as the purchase price allocation as PPA. And then the third category there, that's that older building study, historical look back, the fixed asset review. That's something that a client's owned for a year or more. You'll see on a couple of the slides moving forward that that's kind of how we group a lot of different things for all of our cost seg studies.
Okay. And it says all three can be incorporated into 1031 exchanges.
Okay, on this slide here, what we're showing you are all of the typical industries that we work with in cost seg, and then on the right side there, what we're showing you is the average percentage of personal property that we can carve out from the total basis of that building. As you can see, anything manufacturing, high-tech, pharmaceutical, restaurant, residential rental, those are all extremely prime candidates for cost seg and going to have high amounts of personal property. The one thing that I will say on the slide, you see warehouses and distribution facilities at a low percentage of 10 to 15%. I don't want that to scare anyone away from thinking those are good candidates because I'll be honest with you, we probably do more warehouses than anything. Honestly, we do a ton of them every single year. Warehouses and especially distribution facilities, they tend to be very large structures. So those large structures tend to carry a pretty large basis. So if you're taking 10 to 15% of $5 to $10 million, that could generate a significant tax savings for the client.
Absolutely, yeah. So I'm thinking on the investor side, owning these buildings too, where maybe I'm not the tenant, but I own the the warehouse that I've got someone in, stuff like that. Great. Now, tenant improvements. So going back to Taco Bell, um, you know, a lot of times these guys like Taco Bell, for example, maybe every 7 or 8 years, they essentially have a facelift that they do. How does that relate to my owner who is not paying for that facelift, for example? How do we handle those?
Well, the owner they would not be able to take advantage of that build out. It's who's carrying the tax liability on it. So if Taco Bell is paying for that facelift, then unfortunately that owner would not be able to do a cost seg study on those improvements. It would have to be Taco Bell as the tax liability.
Okay. Okay. Let's see.
Okay. What we're talking about here is identifying candidates for cost segregation. So essentially, every property owner is going to fall in one of these categories. It's going to be someone who's owned a building for a year or more. And while we do say back to 1990 on the slide, I'll tell you it's probably more realistic to say probably back to 2000 at the latest. Once you start getting past 10 to 15 years old, it's hard to find enough benefit to make the study worth doing at that point. But the main point is any building someone's owned for a year or more, up to 15 to 20 years, we can look at it and see if there's enough benefit there. More importantly, you'll see this kind of the magic number here for any category. It's the $1 million of depreciable basis. It is really what will determine if the project is a viable candidate or not. So moving forward with acquisitions, if somebody purchases a building, we're looking for $1 million minimum basis, not including land. And I point that out because you may have a $1.5 million purchase and think that, oh, I'm good, I meet the $1 million threshold. However, I do have to allocate a percentage of that $1.5 million to land. So
Right.
that $1.5 million building purchased in San Francisco versus being purchased in Omaha, Nebraska, are going to have drastically different values when it comes to allocation to land. I may only have half the value left for that building in San Francisco, whereas the one in Omaha, Nebraska, I'll probably still have well over $1 million to work with, even after allocating for land. So just keep in mind, it's $1 million minimum basis, but you do have to consider where is that building being purchased.
So what he's saying here is that you can write off the improvements on a property, but the land, the dirt underneath it, you can't write that off. It's just dirt, right? And it's not going to depreciate in value. So the value of the land is going to be a portion of your purchase price. In San Francisco, that's going to be a big part of the purchase price, that value of that dirt. The value of the dirt in Butte, Montana, versus the building is going to be significantly less. And the value of those improvements need to be over $1 million to make this really worthwhile.
Correct.
Okay. And so on a renovation project, how does that work?
So for renovation, the reason why we can kind of lower that minimum down to around $500,000 is, if you think about it, when you're renovating a space, you're not dealing with a whole lot of structure typically. It's mostly involved with the interior build out of that space, and the interior build out of any building, of any space, that's where we're finding the most personal property. So there's a higher chance that a larger percentage of that $500,000 will go to personal property versus a brand new $1 million building construction. So that's why when it comes to renovation, we can look at something that's a little bit smaller. It doesn't have to be $1 million. Um, and I'll finish on this slide by saying, these are the absolute minimums that we're looking for, but it doesn't necessarily mean it's still going to be a great candidate. This is just the point where it starts to make sense, where we can probably find enough benefit to make the study worth moving forward with the client. So benefits will be small with these numbers, but it's doable at this point.
Let me ask you this. I have a client who just closed, I think, 19 condos. And I think the price point was about $2 million or something like that. Is that something he could bring you guys in and he just...
Absolutely. Yeah.
Okay. So that'd be a good candidate. So just, I mean, even little condo units work as long as the price point's at a certain point.
Yeah.
It starts to make sense.
In that situation, maybe not each individual condo is $1 million, but the total, as long as the total basis between those 19 is over $1 million. Now, I will say with 19 locations, if it's still only over $1 million, that could be tough. If they're all in different locations, if it's all in one building, it's probably feasible at that point. But if they're in different cities, all 19, it's only $1 million basis between those. It could get a little. It might be a little difficult to do at that point.
Okay. So this is what we need to get you to be able to do something like this.
Correct. And again, you see the difference, the same three categories that we break things down into. So for an existing building, something they've had on the books for several years, or even a year, they've already done a tax return on it, so they should have a depreciation schedule that they can provide to us. And what we look for in the retaining situation is the address, a little bit about the building and what type of facility is it. Are we talking office building, warehouse, apartment, etc. For the acquisitions, just a copy of the property closing statement is really all we need. But if you have the building appraisal, we certainly like to get a copy of that. There's a lot of good information, as you know, that's provided in building appraisals, and that will help us dial in our initial estimate of benefits. The more information we know about the property. And I mentioned land value there. They can provide it, but I'll be honest, I don't think I've ever had a client provide us with the land value. It's always something that we kind of have to go and look up in the property tax records, because closing statements typically don't separate land value. It gives
right.
Some value for new construction projects, we ask for the most recent or final G702/G703, which, don't worry, that's just a fancy term for the contractor's pay application. The contractor's pay application is going to show the total cost of the construction. It's going to be broken out by all the individual construction trades: concrete, electrical, mechanical, plumbing, etc. And so that gives us a lot of detail and enough information to be able to estimate how much commercial property should be in that type of facility. And obviously, we know what is the place in service date, when is that construction going to be completed, or when was it completed. That's really all we need.
Okay. All right. Yeah. So you don't need on a acquisition. You don't need an appraisal, right? I mean, a lot of our clients are buying things with cash when they do these things, but it helps quite a bit.
Correct. It's not a requirement to have, but we just tell them that it does help us dial it in a little more.
Okay. So let's see here. Tax Cuts Job Act impact on cost segregation.
So there were a couple of items that we'd like to point out that came from changes to the Tax Cuts and Jobs Act back in late 2017. Most of this first one here on the tax rates, most people are aware of. The corporation tax rate was reduced from 35% down to 21%. Individual rates went from 39.6, essentially 40%, down to 37. The individual rates obviously not a huge impact for us in the cost center world. On the corporation side, obviously going from 35% down to 21, that's a pretty significant hit. However, a couple of items that I'm going to talk about here in a few seconds, the Section 179 changes, the bonus depreciation changes, kind of help counteract that reduction in tax rate to where it still makes corporation projects worth doing. next point there, we used to have qualified leasehold, qualified retail, qualified restaurant properties. Anytime you did improvements to a space, and those carried a 15-year class life, those were all eliminated as of the end of 2017. And now, anytime you do an improvement to an existing space, it just falls under qualified improvement property, which, based on the current tax code, carries a 39-year class life and is not eligible for bonus. The important thing to note here is they did intend to make qualified improvement property a 15-year class life to match the previous qualified leasehold, retail, and restaurant properties. But they made a mistake when they did the update, and they never fully incorporated that. There is talk that they intend to make a correction to the code and make qualified improvement property 15-year, which would make it bonus eligible at that point. But they haven't made that change. In the cost seg world, we haven't had any real concrete news on when that change is going to happen. So for any project that falls in this category as of today, we would have to treat it as 39-year and not eligible for bonus.
Bummer. Bummer.
Back up 1 second there.
Oh, sure.
Sorry about that. So Section 179 expensing, the big change here, the limit increased from, I believe it was 500,000, it's now 1 million, with a $2.5 million phase out. More importantly, the roofs, HVAC systems, and fire protection, anytime you do improvements to existing space, those items now qualify for Section 179. Previously, those things were 39-year property and you had to capitalize it. So now the fact that they qualify for Section 179 expensing, which I mentioned earlier with the roofs, that's a big deal. You can buy off those amounts.
Okay.
Do some improvements. The bonus depreciation, the major changes there were it went from 50% to 100%. We have to phase out for 2026. I think for us in the cost seg world, the change from so bonus depreciation used to apply only to new construction properties, but after the Tax Cuts and Jobs Act, it now applies to acquired properties as well, and that was huge for us because the majority of the projects that we do are actually acquisitions. And prior to the end of 2017, they were not eligible for bonus depreciation, but now any acquisition moving forward is. So that was a big advantage for us in the cost of it.
Okay. All right. Let's see. There we go.
Okay. So I'll finish up here by why choose CTI for cost segregation. I feel that we have a pretty competitive fee throughout the market. We're not going to be the cheapest, but we're certainly not going to be the most expensive, like a big four firm. We base all of our fees off of it's a lump sum flat fee, and we calculate it based on the amount of man hours we expect the project to take. It's not based on how much benefit we think we can get you. It's simply just based on man hours. The typical fee range is for a standard project is, I'd say, $8,000 to $12,000. Now, last year, I'll say that we had a project as low as $4,000, I believe, but also had one as high as I think it was $80,000. So it can vary quite a bit, but overwhelmingly, the majority of them fall in that $8,000 to $12,000 range. Okay?
And so that's one of the reasons about $1 million value for the improvements is about the minimum. In addition to probably some other reasons, but some CPAs can do some of the easier stuff, but it makes a lot more sense to have you guys go in there in detail and pull everything out and put it on its own schedule.
Correct.
Okay.
Which almost leads to that next point there. I mentioned it when I talked about our team of directors. We do have the right mix of engineering, construction, and tax expertise that you really need to put together a credible quality study, and that's very important.
Do do they get challenged very often? Like when the IRS gets to it?
I'll say that cost seg is not something that gets challenged very often by the IRS. I'd say your larger clients and larger projects might, but for the most part, they seem to be focused on like R&D studies. Um, but cost seg isn't audited very often.
Do you guys help them out if something like that happens?
We do. So
Okay.
that kind of touches on the last 2 points there. With every project, we do provide a very detailed and thorough final report to both the CPA and the client. It's extremely detailed. We have a 100% audit success rate with our studies. We've never had a study thrown out. So it's very defendable, if you will. And we do include unlimited audit support at no cost to the client. So that if they were to get a phone call from an agent questioning a cost seg study, we defend it at no cost to the owner. We're confident in every study we put out there. We're not taking any measures on our studies to overly inflate any kind of benefits. We know what qualifies and what does not, and we stick to those rules.
So if you're watching this and you own a building that is worth over $1 million, I mean, they can call and talk to you guys for free, right? You guys can take a quick look and say, yes, this would be a good candidate or not.
Absolutely. It usually only takes 5 to 10 minutes with a phone call. I'll get a few details from the client, and I can tell whether or not it's going to be a good candidate. In terms of turning around an actual feasibility estimate, that's only roughly 24 to 48 hours. Once I get those details from you, I can have the full benefit and how much we think that study will cost to the client.
Great. Yeah. So if you're in that price range, whether you're buying something or building something, or you even own it, if you've owned it for a couple of years even, it's worth giving them a call and seeing if this would be something that they could help you out with. And because very few people are going to sit there and own their building for 39 years. And there's some people that do, but usually you want to pull out all the depreciation you can, and then move on and probably do a step up into something larger and keep writing things off. Yeah. All right. So let's see here. Here's you guys.
Yeah.
Is Stephanie still with you guys?
She is still with us. She actually kind of oversees our WOTC department. I should have given you a slide with Philip on there as well. But yeah, that's myself down at the bottom. I think it may have cut off my contact information, but I can get that to you separately.
Okay. Yeah, we'll make sure that Bill's information will be, if you're seeing this online later, it'll be somewhere in the description, as well as mine. I would highly recommend, if you own a building, if you're buying a building, if you're building one, give them a call if that would be helpful. Here's us. This is my team. We're, again, a commercial real estate investment brokerage. We specialize pretty specifically in helping apartment owners trade their apartments for low management, mostly hands-off stuff like Taco Bell, Burger King, that kind of things. My information's there. It'll also be below. And we do have strategic partners like Bill here for cost segregation and other offerings. Bill, thanks for your time today.
Of course.
And hopefully this helped those who are watching, and we will talk to you next time.
Sounds good. Thank you.
All right. Thanks. Bye.